Just like to thank everybody for joining us this Thursday morning. We're supposed to have a good group from the UK and South Africa. I think there's only a few people on the call at the moment, but we're expecting more to join in the next couple of minutes. So this is the start of a series of webinars that SAIL will be hosting. If you do want to be included on our mailing list to see what other webinars are around, please let Mel know on the chat, and she can include you on any correspondence in that regard. Quite importantly, as we start this, if we just look at SAIL and the way that we approach things, we are not big believers in a get-rich-quick schemes. So we believe that we live in the real world and that everybody is best suited with a long-term plan to investing. So in a lot of our webinars, while we will give tax tips which should hopefully save you money in the short term, actually a lot of what we're trying to do is to give you some good things to think about. Everybody's in a slightly different situation. And hopefully if we can give you some good advice around the things that are important, that'll just better set you up into a better place to be more successful in your own investing. So with that as a start, first key principle that I just want to make sure that everybody's on the right page on, please, is that we need to understand that investing is actually the same as gambling. There is no difference. When we're investing, we're taking a bet. The only difference is that in gambling, the odds are often or always stacked against you. And what good investing is about is changing that equation. It's about stacking the odds in your favor by getting better information. So the more information that you have, the lower the risk you're running and the better the investing opportunity for you. And that's a very important principle that then drives through a lot of the other things that we then talk to you about. And I'll come back to some of these things. Okay, so topic today is investing offshore. And the first thing that we do is we ask our clients, why offshore? Why is it that you actually want to invest offshore and not invest in the country in which you're based? Is it because you're looking for higher yields, so a higher return on your investment? Is it because you're thinking of emigrating and you want to establish yourself in that new country and start to build some assets in that new country? Are you just looking to diversify? Is it a currency hedge because you're worried about the value of the currency in the country in which you're operating? Is it just because your friends say you should go offshore, and if you don't go offshore, that you're being silly? Is it because you're looking to do estate planning, inheritance tax planning? You're thinking of your future, you're thinking of your retirement. Now, the why is very important because depending on why you're doing this, it has a huge impact on what assets you're going to go into, which country you're focusing on, what's your risk appetite. It may also mean that actually you don't need to take the steps of going into that country to invest. You could do it through some of the mechanisms that are sitting straight in front of you that are offered by your local financial services provider, which could come at a much lower cost, but achieve what you're trying to, achieve your goal anyway. Okay, so the most important question to start with is, why are you doing this? Once you've figured out why you want to invest offshore, the second thing that we look at is, what yield are you actually looking for? Okay, so what I've got here on the screen in front of you is it's a South African example. We could apply it as easily in the UK. So what we've got here is a situation in the middle column where a client has a 1-year fixed deposit with a bank. Okay, currently in South Africa, you can get 9.8% yield. So you invest 100,000, your income for the year is 9,800. If you can use your interest exemption, it means that your overall yield is going to remain at 9.8%. Okay, if you can't get the interest exemption because you've already utilized it, you're getting 5.5%. The equivalent in the UK at the moment, now that interest rates are higher, is around about 5.5% gross before any tax. Okay. Now, this in theory is a low risk investment because you're putting it in with, it could be with a big financial institution that is pretty safe. That's your starting point. Okay. If you cannot get a higher yield than that, investing offshore, why are you doing it? Okay. And that also comes into asset valuations. It comes into everything. Is you working off this benchmark and you're saying, if I can put my money into a place where I get 5.5% in the UK in sterling, okay, if I put it in South Africa and I get 9.8% in rands for that 12-month period, when I'm investing in another asset, I must be looking to try and get more than that at the moment. Okay, otherwise, this investment is probably not the best one. I'd rather stick that money in a fixed deposit. Okay, so this is almost the starting point. So you're then going, okay, I'm then going to look offshore. I'm going to invest that 100,000. As I look at it, what am I expecting to get? So what's my local income? What is my movement in Forex? Giving me my gross income. What costs am I going to have to incur to then get that money back into my home country? Am I going to get a better investment than if I leave it in the bank in my local country? And this comes back to my initial question, which was, why am I doing this foreign investment? Okay. If it's because I'm worried about the currency, okay, then that's what I'm betting on. I'm betting on the fact that my local currency is going to depreciate. And so even though I might only get 10% in local income, okay, I'm going to get an additional FX benefit. Okay. And I know that that's the reason I'm making the investment. And then what's important in terms of offshore investing is, do I know what those costs are and the tax I'm going to be paying so that I know what my ultimate yield is going to look like? We often get clients who go, okay, well, I'm investing offshore. That means that I only have to worry about any tax I pay in that foreign jurisdiction. I don't have to worry about anything that I pay in my local country. Okay, it doesn't work like that. Okay, it's very important to understand what are the tax consequences going to be so that you don't have any surprises. Okay, so talk about why am I investing? Second thing is around yield, and we can have whole different sessions on how do you calculate the yield? How do you compare that yield to the relative risk of that offshore investment? That's not in scope today, but that's something we can cover if anybody's interested. If you are interested in having a session on that, please just pop it in the chat and we can go through that in a lot more detail. So coming back on this, what am I betting on? And can I get the right yield in that offshore investment to offset some of the different and increased risks and the costs of investing offshore? Assuming you're comfortable that you can do that, the third thing we look at is, okay, great, which assets and which countries? So we've got a whole lot of assets that we could look at investing in offshore. We can look at listed shares, unlisted shares. We can look at ETFs. We can look at index funds. We can look at bonds or fixed income. We can look at other assets like commodities, so gold. We could look at art. We could look at whiskey. So there's various other things we could look at. Which country do I want to invest in? Okay. So we could, for example, look at a developing country because you're potentially chasing higher yield, but that obviously comes with some higher risk. So how do you then get enough information around that country to get comfortable that that investment is worth it? And I think this is an important takeaway, please, is what I found in my personal experience with investing is I may call the macro situation right. In other words, I might say this country's in quite a bit of difficulty. Over time, it's going to count against them. But I've also found that because I'm not in investing on a daily basis, I might get my timing wrong. Okay, I might get the wrong, the wrong equity share right, because I don't spend enough time looking at that company and saying what's actually happening at Meta or whatever else it might be. So I think one of the things that's very important in this space is, what are you good at? So if your experience is in, in property, then that is a skill set that you can transfer quite easily in looking at property in another country. There will be some differences, but the fundamentals remain the same. Do you run a restaurant and you know how that business operates? Then maybe that investment you're looking at is an unlisted investment or an unlisted shares in a restaurant business in that other country? Okay, are you in hospitality? Are you in financial service? Are you in IT? Play to your strengths, because that better information reduces the risk of the investment that you're making. So how can you leverage your skills to pick the right assets and location? So what I'm good at is not necessarily what you're good at, and you can use your advantage to make sure that you are making a better bet, a better investment, because you understand that sector. You understand the challenges that are faced. If you are not comfortable that you know what your skill, and your skill set might be picking people. How do you build your network and pick the people that you invest in? And if you're uncomfortable with all of those, then rather go for something that's listed, or it's a bond or fixed income, where actually your level of risk is a lot lower and there's enough information available in the public domain for you to say, I know what I should expect here. It's a listed share, they're in utilities, they're a water company, they've got a certain dividend yield. I'm not going to get huge capital appreciation, but I know what my yield's going to look like. Okay, they should continue to pay 3.5% dividend. I'm happy with that, and they're a stable company. Okay, or if I'm looking at bonds, it's a big corporate in that particular country. They should be okay. I'm happy with the yield that I'm getting on that bond and the coupons that I'm getting. Okay, so address your investment in your asset and the countries you're looking at based on your experience. And if you're not comfortable in your experience, then go for the safer things that there's a lot more publicly available information. Okay, we talked about the why am I doing this. We talked about yields and looking at yields and doing the maths around that. We've talked about, okay, so I've got to look at which assets I want to invest in, and I want to look at which country I want to go for. Okay, so once I've thought about those things, what are the risks that I need to consider? Okay, so now we are no longer in a country where I have all the information, I read the papers on a daily basis. So there are some macroeconomic risks associated with that country. Inflation, FX rate. Okay, I'm deciding I want to go into a specific asset, so there must be some risks around that asset class that I need to think about. There's the FX risk. Okay, so yes, I might be sitting in South Africa and the rand has been depreciating considerably for a period of time, and I look at the fundamentals and I say they are very bad, but that doesn't necessarily mean that the FX will always move in one direction. Okay, so is that what I'm betting on? There's the tax risk. So do I understand the tax consequences of making the investment? And when I actually get that money back into my local country, have I considered all the taxes I have to pay? What if legislation changes? Okay, how do I try and bring that into my consideration for the investment? And are there any other country-specific issues that I need to think about? So somebody investing in the UK prior to Brexit would never have thought about the potential consequences of Brexit on how the UK has done and how that's impacted specific companies. Okay, we don't know at the moment from a macroeconomic perspective what the potential implications are of instability in the Middle East, on top of what's happening with China. There are a lot of things happening at the moment at a macroeconomic level, which means that as we invest offshore, we need to think about these and go, okay, am I comfortable that offshore investment is either protected from some of these risks, or I'm doing it for a long enough period of time that actually it's probably not going to have a major impact. It might have a short-term impact, but I'm investing for 20 years, so therefore I'm less concerned about it. Okay, but I'd like you to think about these risks and say, am I happy with them? It might be that you go, okay, there's no difference me investing in this other country. The risks are the same as my home country. We're also facing the same challenges. Okay, so it actually doesn't matter if it's there or here. I'm going to be faced with the same risks. So once you've then considered the risks, okay, how do we start with these offshore investments? So we've gone through the thought process. Okay, why am I investing? What am I good at? How can I use what I'm good at to decide on what I want to invest in. Okay, what return am I looking for? Okay, what assets and location and what structure? So I haven't really dealt with structure in this conversation. But as we look to invest offshore, particularly if there's a fixed asset, so potentially a business that we're trying to set up offshore, a different business structure might be appropriate. Okay, so it might be through a trust, it might be through a limited company, it might be we decide we're just going to invest in our personal capacity. Okay, I think I'm not going to spend a lot of time on this. We can do a completely different session on it. The key thing probably is if you're not going to invest a lot offshore, then just do it in your personal capacity. Okay, if you're considering investing quite a bit, then a different structure might be better. Why? So if we go and set up a limited company in that country, it is going to cost us some additional amounts in admin, but it means that if that investment works, then we are better able to change the timing and the nature of how we pay that money back to ourselves in our home country. Okay, so if we're investing enough, then the tax structuring around that and how we manage things could be far better. Okay, but that is up to the individual, how they're making the investment, how big the investment is, etc. Okay. I think one important thing here from a thought process is never to forget, some of the best investors in the world, the Buffetts, the Grahams, etc. They have a couple of key principles that they talk to clients about in their investment process. The one is the benefit of compounding. Okay, so as we look at these offshore investments, we're not really into a short-term speculative type investment. We're really looking and saying, are you going to do this on a long-term basis? And are you then going to be able to take advantage of the compounding effect? So I'll deal with compounding in a different session, but the compounding effect is really if you can get a solid 7, 8, 9% per annum for 20, 30 years, and you're putting a good investment every year into that, the compounding effect of interest on interest, or the return on return, will have a massive beneficial impact on your investments. Okay, so that's that long-term investment getting a good real return every year. And the second thing that they often work on as a principle is avoid big capital losses. Okay, so if you are going to invest, you might be somebody that likes taking a bit of risk. Okay, and that's great, but you need to understand that risk, because for most of us mere mortals, a big capital loss because we made a bad investment is a lot harder to get over. So if you run the models and you do the maths and you look at a situation where you make a £50,000 loss, that's often quite hard to recover from. Okay, so those two principles are quite important through the thought process and long-term planning is, how do I benefit from compounding? So it's a long-term, good, real return that I reinvest over that period of time. And how do I avoid any capital losses? Second key thing in terms of how to start is, depending on what you're investing in, get in contact with local suppliers and build a network to support you. So actually, interestingly enough, on this call, I think I haven't checked the guest list again, but we've got 2 people who actually provide a support service for clients investing in property in the UK. Okay, so one we partner with, the group called Wealth Trek. So they offer a process where they help South Africans invest in UK property. And why is that important? Because they introduce you to somebody who can find the right properties on the ground. Okay, because you haven't spent time in the UK if you're sitting in South Africa. So they'll find the right properties, so they'll source things for you. They'll introduce you to conveyancers, maintenance people, all the rest, so that when you invest in the property, you've then got a support group that can help you manage that investment for the period of time that you're investing. Okay, now those local contacts are extremely important. Now, obviously, you don't need that if you're investing in bonds or listed shares in that offshore environment. But if you are going into a physical asset on the ground, or you're setting up a branch of your business, okay, then having those local contacts actually reduce your risk significantly. Trying to manage something a couple of thousand kilometers away can be extremely difficult and expensive without that network. Okay, so if you are going to look at that sort of investment, please think about what is the network that you need to support you locally. And it might also be a local tax consultant or a local lawyer, depending on how much you're investing. Okay, so once again, it's that cost benefit. You then far easier than for those in South Africa. But even for those in South Africa, you can legally move up to 11 million rand per annum per person. So that's 22 million rand for yourself and your spouse if you do it through a regulated broker. Okay, and you may, South African or UK, you may need to set up an offshore bank account depending on what you're investing in. Okay, so it depends on the type of business, depends on how you're going to extract money from that business. Okay, so just think about that, because sometimes that setting up of an offshore bank account actually could take you a little bit of time to do. And once again, it comes down to how big is the investment you're making, and therefore, is it worth it or not? And then you invest. Okay, and then obviously there's the whole process that kicks off of monitoring your investment, reinvesting your returns, getting those funds back to your home country, and thinking through that whole process. We're quite big fans on modeling. Okay, and I know that modeling is not, and talking about financial modeling, spreadsheets, and all the rest, I know it's not for everybody, but the reason we quite like it is it allows us to work through step by step what are the things to think about. Okay, so let's just talk about property investment, for example. And we're going to go buy property in Portugal, okay, or Spain. And we look at it and we go, okay, I've done my maths, I've talked to local agents, I've built my network. In my model, I think I can get this return. These are my costs. So there's insurance, there's all the different things I need to refurb it. I work through that process. And then I go, okay, so what happens next? Okay, so that's successful. Now I want to buy my second property. Okay, how's this going to impact things? My third property, fourth property. Okay, they're going to be different areas. Does that change things? Okay, how do I get a mortgage? Okay, now I need to think about financing. Am I always going to put in myself? So the modeling allows you just to work through that thought process so that there are less likely to be surprises. Okay, and then you can pass that model on to somebody and say, okay, what haven't I thought about? What taxes might there be that, I've put in, yes, I've got it in a limited company. That's the tax rate there. What else do I need to think about? And your advisor says, well, how are you going to get the money out? So you're going to pay a dividend, or you're going to sell the shares in the company that you've set up there? Okay, this is how it'll be taxed in the UK, or this is how it'll be taxed in South Africa. Okay, so this is the overall impact. But if you set it up like this, then you could end up paying 10% tax, not 30%. So there's a big saving there. So that model allows you to think through all of those things. To summarize then, so the key takeaways I'd really like everybody just to get from this session today. Okay, I know that it seems like I've talked about a lot of the a lot of reasons why potentially not to invest offshore. That's not what I want you to take away. I want you to realize that investing offshore can be very beneficial. Okay, particularly if you're worried about your local currency through diversification, trying to target better yields. But you need to know what you are betting on. Okay, are you making a bet purely on the currency? If that's the case, why don't you just enter into some sort of contract to protect yourself against a weakening rand, for example? Because if you're betting on that, there might be a simpler way to do it. Okay, leverage your personal skills. So if you are very good in a particular space, okay, then that gives you an inside track and better information, which reduces your risk. So you can then go into that foreign country, maybe make an investment in an unlisted, or in somebody else's company, but doing something similar to what you're doing, and take a minority stake, but you can see whether that person is any good. You can monitor that business, and you can help that business be successful because you've got the skills in that area, and that's unique to you. Understand and work through the risks. Understand your target yield and how you will get it. Okay, so it's all very well going, I want to get double my money, But is that realistic? There's no point in going and putting it into a bond and hoping you'll double your money. You'll have to expect, yield interest rates to drop precipitously in that country. Is that likely to happen? Okay, so the yield that you're going for must be linked to the asset that you're investing in, okay, and the probability of being successful. So you can look at that and say, okay, what is likely to happen here? Okay, if I'm going and investing in a tech stock, hoping that it's going to make me 8 times money, but I know nothing about that business, I'm gambling. If, however, I've looked at the technology, I know the market, that it's a great technology for that market and that there's a real customer base for it, and I know the people that are running it, then actually that is a safer investment than not knowing anything about that business. So knowledge is power. The more you know, the better your local network, the lower your risk. In terms of building that local network as well, remember, it's not in my view, it's not a sprint. Okay, it's a marathon. So you can take the time to get to know people. You can limit your investment until you've worked out how does this industry work in this other country. Okay, what's different? And then when you really understand it and you're comfortable with things, then you can say, well, actually, this is fantastic. This works brilliantly. I know that this can get me my return. Or you might go, okay, I've learned a lot, but this is a bit of an unsafe one. There are too many things that I'm uncomfortable with. The language barrier is a problem. This could create challenges for me. I think actually this is not the right country, but I haven't lost any money here. I've made a reasonable return, but I'm not going to put anything more in there. Okay, so your knowledge has helped you make better decisions. So that's really what we wanted to cover today. So I don't know if there are any questions from anybody that you'd like answered. Mel, is anything from anybody?
Nothing in the chat. If anyone's got any questions, they can just pop them in the chat or unmute themselves. They can chat directly to Jonty.
Okay, so look, a couple of things from this conversation. So we'll make the presentation available. Mel will also send you around a one-page cheat sheet for offshore investing, things that you should think about. Remember, everybody is different. Okay, so also feel free to set up a free 15-minute consult with one of our advisors. We can start to then look at your personal circumstance. Okay, through that little consult, we can identify areas where we think that you can save some money. We can look at specific things that you are worried about. We might be able to save you a lot of pain by saying, okay, actually, from what you've said, you don't need the big bang solution. There are simpler ways to do what you're trying to do. Okay. And obviously, if you have any other questions, you're welcome to reach out to us on info@salesolutions at co.uk. We would be happy to respond to those. So thanks very much for your time today. And hopefully you've taken something out of the session.